think a lot of funds are going to go out of business. It's not the best take, but when money was free in 2021, 2022, a lot of funds were raised. And that cycle takes 10 years to liquidate and get those people out.
Hey, I'm your host, Ryan Dodds. I teach entrepreneurship and organizational behavior at Rollins College, and I'm Senior Director of Product Management at Stacks Payments. In this podcast, we're going to explore what it takes to start, fund, and build successful businesses. And we're going to do that by hearing from an all-star lineup of successful founders and investors. So whether you're thinking about your first side hustle, pitching your startup idea, or just trying to figure out what the entrepreneurial path actually looks like, you're in the right place. And wow, are we lucky, because my guest today is Arron Solano. Arron is a managing partner at Calano Funds, a venture capital and private equity firm with over 15 companies in its portfolio across fintech, consumer packaged goods, adtech, sports, and influencer marketing. Arron has seen close to 10,000 deals over his career in venture capital, sits on the board of 6 companies, and is an alum of UCF and Rollins.
All right. Arron, welcome to the show.
Appreciate it. Thanks for having me.
It's great having you on. First guest, so no pressure.
There's a lot of pressure.
I will have fun. So, all right, you are a venture capitalist now, but in your past, you were actually a founder and then made that transition into venture capital. Maybe just to set the context for the listeners and watchers, what was that like transitioning? What kind of drove that decision, and how are things maybe different?
Yeah, absolutely. Early on, before I even had the founder piece of the tech company that I had in the hospitality space, I was in pharma sales. And so I actually worked with a company that went IPO, and I engaged with a bunch of investors at that point when I was a part of that company. So I had early exposure to people putting money into businesses, buying a chunk, scaling them, and then making good money. Then I went and founded my company, tried to raise money. It was very hard, especially here in Central Florida at the time. This was 2015 timeframe. And I quickly realized that being the operator, I was on the wrong side of the table. Being the investor was the better opportunity. And so I slowly transitioned out of that company that I had founded and co-founded actually with the Rollins alum. And luckily had an opportunity to join a local venture firm here called Arsenal and help them run an early stage fund as well as their later stage fund. And so for me, the change of pace of the daily grind as a founder, you're on 24/7, everything falls on your shoulders. As an investor, I'm betting on the founders and I'm not taking as much as the stress load and day-to-day activities. So it is a change of pace, but it was a nice, nice move and the right one I felt for me. Some people are wired to be founders in that frame. I'm a founder of my new firm as well, but it's not as intensive as founding a tech company at that time.
Yeah, and your company was Blurtbox, was it?
Yeah, so Blurtbox was anonymous feedback for hospitality venues. So Orange County Convention Center was a customer, some Rosen hotel facilities here in Orlando. And basically, people are uncomfortable having face-to-face conversations with staff and giving feedback. And so we allowed it to be anonymous. We could still reach out to you, but you never had to give us your phone number, email address, or any contact information of yours. And this was early on AI. So we tracked what you said and put a score to it. And if it was a high score, then it was immediate concern to the teams. Yeah, that was a fun run. A lot of good stories from that time.
Very cool. And so you've been in venture since then. You're a managing partner now at a firm. Demystify the venture capital role for us. What does a venture capitalist actually do?
Yeah, it's never the same, but let's just walk through a week of what my life looks like. So it's myself and my partner in our fund. We're a lean team. So some funds are much larger. So you could have 10, 20 to 100 people part of a firm. For us, it's 2 people. We have to agree on everything that we do. So it's 100% support from the firm when we do a new deal. Mondays, we have our partner meeting. Before that, it's a lot of catching up. So emails coming through in the weekend, text messages, I will say one thing as a VC, you're always on. So a lot of our founders will text us. A lot of our investors will reach out to us, different things and engagements that isn't a 9 to 5. So it doesn't fit in that gap. So for me, I get all that housekeeping out of the way in the morning. Partner meeting happens at noon on Monday. Typically, there's some action items that come out of that. Hey, we need to reach out to this company and finish the financial model or whatever it may be. Tuesday for me is when I try to fill in calls and heavier days of conversations. So companies pitching us, talking to our founders, doing monthly updates, different things like that. I just condense it all. So I have one full day of just a lot of conversations. And then the Wednesday is a little bit more analytical and running financial models, getting into the weeds with our companies of how we can help them hire better people, sales opportunities, different things like that. Then, unlike most firms, Thursday, we have another partner meeting, but we like to give quick feedback and have a tight loop with a lot of people that we work with, even prospective companies. So this allows us to meet one more time during the week as partners, get another feedback loop closed, and then reach back out to founders and whatever we need to do from that time frame. And then throw a board meeting in there at some point, sometimes during the week. Those are quarterly. So sometimes those land on the same times. 2 weeks ago, I flew to Atlanta at 6 a.m., landed at 7:30, jumped on a board meeting from 8 to 11, walked out, got a coffee, went to another board meeting from 12 to 4, jumped on a plane, got home. That was the day.
Wow.
So not always the same stuff.
I was going to say, like, there's a sense like there's so much variety in your
Mhm.
role. So if you're someone who kind of thrives on change of pace and getting into different activities, seems like it's a good fit.
Yeah. If you're not organized, it's very hard because it all stacks up real fast.
Right.
But if you can handle those things and those random things thrown at you daily that are different and you just jump in and go figure it out, it's a phenomenal opportunity.
Yeah.
It's a lot of fun.
Yeah. And Calano describes itself as a venture capital firm, but also private equity. Can you
Mhm.
just break down the difference between those?
Yeah. So we originally started out as a VC or venture capital firm. And so we raised an initial fund. And then throughout that, just organically, we've had conversations with other business owners and groups around. And we then had opportunities to invest directly into these companies. And they weren't as high growth or as fast growth as a venture investment would be, which is something that a lot of people talk about, trying to hit that 10x multiple or try to 10x your money in those deals. And so these are still good deals, those other ones that are a little bit slower. So yeah, so years ago we bought a boat manufacturer in town. Can't say the name, but we are on the board there, and that is more of a private equity deal for us. That is a little slower growth, a little bit more methodical, no sexy tech behind it or anything. It's literally manufacturing.
It's a
And
boring ass business
it's
that could
just
hopefully
boring and it
return
scales.
something.
And I will tell you, there's nothing wrong with those. There's a lot of that out there in opportunity, especially nowadays. And then on the venture side, yeah, we're going for home run hits. So you're going companies that have to grow fast, scale fast, and somewhat like a rocket ship. It's either it takes off and it goes, or it implodes on the way up.
Yeah.
And some barely even get off the launch pad if they do. And as you have seen probably with other people around you. But the difference between those two for us is the venture capital side, there's a specific fund to that. So we have money allocated to get specific deals. Private equity side, when we do those type of deals, it's one-off and we'll go raise money individually for each one of those deals when we do this.
And you mentioned grow fast and scale fast. At the stage that you guys are investing in or that you're helping manage, is it grow at all costs still, or have you seen more of a focus on profitability?
Profitability is a goal. That terminology has come back into these conversations. I would say that once a company clears about $1 million in revenue, there has to be somewhat of a line of sight to how that profitability would occur down the road if they raise more money. And to even take a step back, when we talk about raising money, companies going out raising from investors like myself, there could be multiple times they do that along their progress of a business. For us, we're more of a conservative investor. So some of these companies will go raise hundreds of millions of dollars and blatant, just straightforward say, we're not going to try to make any revenue. We're just going to try to get users in or build the tech to where it needs to be. we like to see revenue as soon as possible. So we search out some different deals and compare to other firms, and that's the nuances in the space too, is certain firms are higher risk profiled, some are less. And so for us, we like to see a balance of smart spending versus spend until we hope something gets figured out. There has to be some logic behind why we're spending. And we do challenge that often with our founders of why they do that, because they get told, go spend on marketing, go spend on ads, go make a lot of money. And it's not that easy.
Yeah. Yeah.
Yeah.
That's great. That's great. All right. Thanks, Arron. That's amazing context on you and your firm. I want to switch gears and talk about the act of pitching. So you've seen numerous pitches. You talk to entrepreneurs who are looking to get funding for their business all the time. I want to see if you could just identify what are the qualities, what are the traits you see as a really good pitch or a pitcher that you can help the students, because my students right now are starting to think through ideas on what they can pitch for the semester, and that'll ultimately go through all the way into a 6-minute venture style pitch. So yeah, any help there
Awesome.
would be great.
Yeah, I would say from the bat, we can tell if someone knows the problem they're trying to solve based off of how many words they use to describe it. And it's so simple to say, but a lot of people spend all this time and money on these professional pitch decks, graphics, all of these things. And it doesn't clearly state the problem being solved or the issue at the matter of fact of like what we're trying to go and build to do. It's this grandiose, we're going to do all these things for everybody type of thing. And we don't want that as an investor. We want you to solve one problem insanely well. And then if that's really successful, we can branch out from that and add to it. But we can tell if someone's pitching us. The last deal we did a mortgage technology company. Actually, that was our second deal ago. Mortgage technology company. The founder came to us and the pitch was done in 45 seconds.
Love
which
that.
Most people.
It reminds me of Stripe. You remember the Stripe pitch was one API and it was a demo, and that was the pitch to whatever VC ended up leading their seed or A.
And some people think that like I'm leaving so much on the table. I need to be able to tell the whole story. They're not going to understand. It's like, no, I want someone that is so clear, concise on the path that they're about to take, because there's so many distractions that will happen along the way. So when I see a founder do that, one, that gives me confidence in the founder to be able to focus on what matters. Two, I know they're not going to go chase the shiny objects. They're going to be focused on one thing. Another thing that's helpful from our viewpoint is someone that comes from industry that really understands the problem. So a lot of people will start companies because they were told about an issue in a space and they want to go solve it. This is more the venture side of things and more build tech around things. What we found is someone that comes from the space and sees all the nuances and says, here's why it was broken at the last 3 places I worked. I want to fix it. And this is how we're going to do it. That gives us a lot of confidence. We're like, okay, one, the user on the other side of that will be using your product exactly how they think by whatever it may be. That's a big value add. One thing I will say on more of a red flag, if you have a 30-minute conversation set up with an investor, and if you're lucky to even have a seat at the table with an investor, don't pitch for 25 minutes. Don't pitch until like the last 5 minutes.
Leave some room for discussion, maybe.
Yes. The amount of people that are like, I used to mentor for Techstars, which is a startup program, and a lot of people would say, I crushed that pitch. So I turn around, I call the VC and say, hey, how was it? Like, I didn't even have a chance to ask questions. Like, of course they thought they did well because there's nothing to be asked. That is a big red flag.
I like that.
And a VC just lets it run. I'm like, if you're going to talk for 25 minutes for me, I'm probably going to
get a call back.
You're not going to get a call back, and I'm probably going to be sending emails during the call, and you're not going to realize it. So
especially on Zoom, right? You can just be
Also, I don't have a poker face, so like you're going to tell when I'm disinterested. But yeah, those are some key things.
No, I like that, and I'll recap them in a second. But just to the problem knowledge or like the domain expertise is so important, and it reminds me of when I was in San Francisco and I was an account executive at Salesforce. My brother and I were about to leave to go start a startup. And the area we were going to go start a startup in was like social, local, mobile. We were going to go build a Yelp competitor. And I remember taking a walk with Alex, who's now at Redpoint, Alex Bard, and our CEO at the time. And he said, Ryan, like, why don't you guys go start a company in like sales tech, right? Like go help AEs be more efficient in their job, right? Because we had that domain expertise. We had been selling software. And so that's been a huge learning lesson for me, for sure. So, okay. So we just touched on domain expertise. So know the domain that you're, pitching something in. And I think that goes along with getting interested in problems in areas that are going to interest you, right? And that you have a passion for. Two, you mentioned, I'm going in reverse order, focus. So they don't have 10, bells and whistles to their solution or 10 different sub-markets that they want to, build for at the seed stage. Just getting off the ground, there's a defined problem and a solution for that. And then the first was confidence, just confidence in how they're presenting, the material, the problem space, the solution space. If they're asked a tough question, they're able to field that appropriately and instill confidence. So yeah, those are all good. And then I do love the tip too about don't take up all the time, right? Leave some time for
and it happens a lot more than you think.
Perfect. All right. So that's great. And I think, like I mentioned in our class, we're going to be doing a lot of work on pitching. So love that. I guess before we move off pitching, has there been any examples you want to share of, you could go good or bad in terms of just like, wow, this person completely missed the mark or they knocked it out of the park?
Give me a second to think. I always like sharing the worst case scenarios.
Yeah.
So no one laughs at the guy that raised $10 million. Actually, I've been in. Okay, so this is previous to my current fund. This was when I was in my other fund, Arsenal. I was in the room with two founders, got into verbal argument in the middle of the pitch, which was phenomenal. Just to see the engagement between like two people that are, not to say you always have to be on your best behavior in front of an investor, but it was, I forgot what the question was, but it was like a middle of the domain question that both of them could enlighten on. And one started talking and the other one just came over the top and like off the top ropes and just like, nope, you're wrong. Here's why you're wrong. Don't answer any more questions in this room. I'm the CEO. I own X% of this company. And everyone at the table's like,
you're getting a view of what the marriage is going to be like.
Yeah. You're like, this is bad. And so, yeah, that was it. That was a quick and easy one. But that one, you also always have the random like tech issues. People like, I have my pitch deck. I don't have it right here.
Live demos.
I've had people literally read notes and I can tell, like you can watch their eyes scanning the bottom of the Google slide note tab and they just read fully off. So there's just some bad experiences. I mean, the good ones, like I will just say like the polished and really solid ones it's such an easy, quick feeling, when the person is either done it before or is just that type of personality that gets it clicks. But the bad ones outweigh the good ones clearly because not many people get money invested in them.
That's right. It's definitely hard to raise money for your company. Okay, cool. So switching gears into looking out a little bit longer term, as you think about early stage investing, company building, et cetera, over the next 5 years, what kind of trends are you seeing? Where should our listeners kind of be exploring if they are curious about starting something?
Yeah. So two trends that I'm seeing, and they actually coincide with each other. The first one, AI coding, has become rampant at this point. If your students haven't engaged with any of these platforms of Bolt, Lovable, different things like that, highly recommend it. You do not need any coding experience. So that is good and bad. One, early stage companies can look like they're a lot more mature and have better tech because they were built off of this, or ChatGPT told them what to tell these systems and then they were able to build it. So you have to be really, really good at seeing what's a vanity metric and what's not. Recently, there was a massive AI company that got exposed for this. Their automated code system was actually just offshore developer team doing things, which is not good.
Yeah.
And
this is the wizard behind the cloak there.
Yeah.
The
but that company had raised hundreds of millions of dollars. So they can get far along down the road and still not be exposed on it. The other side is you don't have to raise that much money to get started on stuff. And I think that's the most exciting thing. And I love it right now. There's the terminology behind it of vibe coding. And yeah, it causes some problems and you have some bugs and things to build, but you can build things real fast.
Yeah. So for prototyping, it might not be the the technical system that you're going to architect for the next 5 or 10 years of growth, I think you'll get to that stage, right? But at least for validating your solution to the problem you've identified.
Yep, you can as someone non-technical, you can get much further along these days, as well as anyone that is technical can be enhanced even further. So the entry-level software developers are having this weird time in this space now of they don't have as much experience, and as well as CTOs don't want to spend time training them as much because they can go do it themselves with these AI coding solutions 10 times faster and know that it's not going to break any systems. So the AI coding piece is a massive opportunity in the market. And then also with the fact of saying that it can get you further down the road, there's a lot more solo entrepreneurs or small companies that are pulling in $1 million to $5 million a year because they just built something themselves and then they marketed it well. But then with where Chat GPT is and all these other opportunities of Gemini or Claude, you can learn so much so fast that you don't need to hire these executives anymore and give up equity in your company. So we are seeing a lot more people coming to us, which we rarely saw before, was someone that owns 100% of the company and it's not split between founders. And we have a few that we've invested in that the founders owned 95% and up coming to us. So for your students, I would say the exciting thing is you can get started much faster now. And I think you can get further to where you can still own a whole business that's making a few $1 million a year, which is a phenomenal opportunity. And then be able to go hire the developers or whatever you need if it
At
is
the right
scaling
time.
at the right time. Yeah. And so we're just seeing the rapid change of pace increasing and compounding. It's going to deteriorate at some point. It's not going to be such large developments every single time, but in the space over the next 5 years, it's going to be high dollar amounts from venture PE into these big names, OpenAI, Perplexity, all those of the space. And then you're going to have that small pocket underneath it. They don't even need to raise money that they used to. And so now people like myself in seed stage are not going to see as many of those great founders coming to raise money anymore because they can do it by themselves.
Yeah.
And so there that shift is occurring already. And over the next 5 years, the wedge is only going to get bigger.
So these solopreneurs that are able to build something in production ready environments where they can, it's not just a prototype. Are you seeing that are they coming to you for money, or are they just running the business as like a lifestyle business, basically? Like, can they keep scaling it in the early stages without venture money?
Yeah, majority of them in lifestyle. Or they go on to like a micro acquire or acquire. I think that's what it's labeled as now. And they sell the business for 500K to $1 million. That gives them some good cash in the bank to then go make a bigger bet on something. But a lot of these, they just don't see the necessity of, because it's not just bringing money on, it's all the stipulations that come with it. You're setting up a board, you start having structure, you have
Right.
financial review, you have all these things that now beforehand you had autonomy to do whatever
That's
you
right.
want. It's not a bad thing personality wise. Some people, it just doesn't fit. And so we are seeing people come to us. It's a double-edged sword. We have other people come to us with stuff that they think is much further along than it really is. And we're like, no, you have a long way to go and you're not going to be able to do that. And we're not going to just throw money at it. And then you have other ones that are technical in nature and they can accelerate faster. And they're like, I'm good making $1 million a year. I don't need to go chase $100 million exit. I get it. It makes sense.
Yeah, that's amazing. All right. So you can look at tools like Bolt and Lovable to just start, and you got to start somewhere. And maybe it's Chat GPT asking something around what tools can they go and explore. I know there's a whole host of them. So awesome. Okay. So the rise in AI, was there another trend that you were seeing, or?
And I just, the solo entrepreneur is going to become more of a trend. Someone that's going to build. So you're taking that potential co-founder or CEO that would technically raise venture money, and they're not going to anymore.
Yeah.
They're just going to do their own thing and build off of that.
Yeah. Because what does that venture money go to? It usually goes to hiring. It goes to
developers. It's usually early. All of these things that can be now bought for $20 a month.
Yep. Wow. Very cool. All right, Arron, are you ready for the all exciting lightning round? I'm going to ask you 3 questions that you can just right off the top of your head. Sound good?
Let's do it. Let's hit it.
All right. So what's one piece of advice you'd give to a young founder who is looking to get started?
Takes much longer than you expect. It's probably not the most exciting thing to hear, but whatever you think you want to do and whatever time frame you think it's going to take, double that and then probably double it again. But majority of the time, it takes about twice as much time as you expect to get to whatever stage it is that you're going. So have a little grit, be resilient. It's not going to be easy. If it was, everyone would do it.
I love that. Have some grit. So don't just give up at the first sign of
Yeah.
failure, but figure out how to push through. I love that. Okay. What's a resource, could be a book, a podcast, an essay you often recommend?
So podcasts, and this is literally all of my supplemental material. I used to read a lot of books. I don't anymore. I listen to, it's called Founders Podcast by David Senra, Senra. He went to UCF and has a massive following now. And what he does is he literally reviews biographies. So founders, CEOs, people that have started businesses, and looks at their biographies. Doesn't worry about the TechCrunch, CNBC News of the world, the Twitter post, or whatever it is. He literally goes back of all these successful people, and you would be amazed at how many traits repeat themselves with these same successful people, multi-billion-dollar founders, and the obsessions they have, the time commitments. And so for me, I love looking at that, and I recommend that to everyone these days because it is tried and true. It's proven. It's not the guy that's sitting in front of a conference right now giving some bamboozled information that you're like, I need a cold plunge for 2 hours. I need red light therapy. I need all these things to become successful. None of that does anything for the business. And then you look at these other guys that are like Warren Buffett that are getting McDonald's and Diet and Coke every single day.
Mhm.
Like these. So it really is, it structures fundamentals. So Founders Podcast by David Senra. There's a lot of episodes. Dive into them. I guarantee you can find a CEO of a brand that you absolutely loved or have used in the past. That is a great start. Honestly, that is all I recommend these days because there's so much to
Perfect.
learn.
All right, we'll have to check that out. Founders. Okay. All right. And lastly, what do you think will be different in the next 5 years in early stage funding, the work that you do?
I think a lot of funds are going to go out of business. It's not the best take, but when money was free in 2021, 2022, a lot of funds were raised.
Mhm.
And that cycle takes 10 years to liquidate and get those people out. So the next 5 years, we're going to be running into 2031, 2032. And so a lot of these firms that got into these hype deals or just spent all their money on deals that didn't return capital, that's finally the exposure time for them that they would be exiting the business. We're already seeing that. We're already seeing funds stopping or their investors saying, we're not giving you any more money. So I think it's going to be harder to find a role in venture at that time unless you are an operator or someone that comes from tech. I don't think the roles from the Ivy League schools are going to have as much say over someone that's gone out and built something themselves and gone in. Not a take that those schools probably want to hear, but
So maybe the junior analyst role who's like just crunching spreadsheets may not be
that's
a,
gone.
a, a
Like
thing.
I have a chat GPT. So I have basically an agent built that runs all of our analysis on financial modeling. I can build an investment memo within an hour compared to weeks or months. So a lot of the shift is that early stage that early stage employee is going to be disappearing, and these funds are just not going to have the capital to be able to put towards staffing at that point. But I do think the larger firms and the big names in the space will continue to succeed. Like I just think more money pours into those.
Yeah.
And
The
the ones,
Sequoias and Andreessens of the world.
yeah, because they can go home run hits at this point all the time. But yeah, I feel like there's going to be the groups that never made it to fund 2 and they just kind of dragged out fund 1 as long as they could, and it's just not going to work for them.
Maybe when it was cool to start a venture fund or have a
Yeah,
venture
and there's going to be
fund
some other hip thing that's going to come out at that point. Maybe it's, I don't know, everyone owns their own pickleball league and team, and there we go.
It'll be interesting to see. Arron, thanks so much for coming on. I really enjoyed our conversation, and hopefully we can do it again.
Appreciate it. Thanks, everyone.
All right. Thanks, Arron. Thank you for tuning in. Would love to hear your feedback. You can email me at rdodds@rollins.edu, and hope to see you on the next one.